Here is the most confusing sentence in finance right now. The S&P 500 hit a fresh all-time intraday high on Friday. The Nasdaq closed at an all-time high at 251.14. Apple surged more than 3%. Markets posted their best month in 5 years. Champagne emoji. Everyone's portfolio is green. Life is good. CNN. Also this week, the U.S. economy is expected to have added just 50,000 jobs in April. GDP grew at 2% in the first quarter, below estimates and less than half the pace of early 2025. A war is still actively disrupting 20% of global oil supply. Inflation is reaccelerating. The Fed is frozen. And consumer sentiment just hit a record low. Council on Foreign Relations. Both of those paragraphs are true. At the same time. Right now. And the fact that they can both be true simultaneously is the most important financial story nobody is connecting into a single coherent picture. So let's do that today. Because this week gave us more market-moving news in 5 days than most years produce in 5 months. And understanding how all of it connects is the difference between making smart financial decisions and just vibing with the market and hoping for the best. Let's start with Apple, because Apple is the clearest window into what is actually holding this market up right now. Apple reported a second quarter record of $111.2 billion in revenue, up from $95.4 billion in the same quarter last year, crushing the Wall Street consensus of $109.69 billion. Earnings per share hit $2.01, above analyst estimates of $1.95. The beat came from iPhone momentum, services strength, stronger Mac demand, and better than expected performance in Greater China. Charles Schwab Federal Reserve Bank of Dallas. This matters beyond just Apple shareholders. Apple is the largest company in the S&P 500. When Apple beats by that margin, it pulls the entire index higher. It validates the AI narrative. It tells investors that the mega-cap tech trade is still working. And in a market being carried by 7 companies, Apple having a good quarter is essentially the market having a good quarter. That is how concentrated things have become. One theme reinforced this week is that AI capital spending is not slowing, with outlays approaching $700 billion in 2026. Markets are rewarding AI spending that shows near-term monetization, as seen with Alphabet, and punishing spending without clear incremental returns, something analysts criticized after viewing Meta's results. Oxford Economics. So the AI story is starting to split. Companies that can show the money is actually working, Alphabet, Apple, are being rewarded. Companies spending aggressively without showing the return yet, Meta, are getting questioned. That is a mature stage of a tech investment cycle. It is the market asking, okay, we believed you, now show us the money. And that question is going to get louder every single quarter from here. Now let's talk about the number everyone on Wall Street is staring at this week. Friday's jobs report. The U.S. economy is expected to have added just 5,000 jobs in April, far below March's blowout reading of 17,800. That is a brutal deceleration, from 17,800 to 5,000 in a single month. And the context behind that number is important. Federal government employment has been declining consistently, down 355,000 or 11.8% since October 2024. Financial activities employment has also been falling, down 77,000 since May 2025. The government job cuts from DOGE and federal restructuring are showing up in the data now. And they are showing up in a month when the Iran war is already pressuring the broader economy. Council on Foreign Relations, CNBC. Here is why Friday's jobs number matters for your wallet specifically. The Fed is sitting on its hands. It cannot cut rates into re-accelerating inflation from the oil shock. But it also cannot ignore a labor market that is softening rapidly. A Goldilocks report, moderate job growth showing resilience without overheating, could relieve investors wary of a weakening economic outlook. But if the number comes in at 50,000 or below, the market is going to have a very complicated morning. Because weak jobs data normally means the Fed cuts. But weak jobs data combined with 3.3% inflation means the Fed is trapped. And a trapped Fed is the worst possible environment for the average American trying to plan literally anything financially. Council on Foreign Relations. This brings us to the contradiction at the heart of everything right now. And it is genuinely one of the strangest market environments in modern history. The S&P 500 and Nasdaq forged new all-time highs, sealing in April with 10% gains for the broader market, the best month in 5 years. Meanwhile, there is a disconnect between the positive short-term environment for risk assets and broader structural instability. Global fragmentation, a depreciating dollar, Federal Reserve independence concerns, and AI capital expenditure trends are the themes to watch. Oxford Economics, Al Jazeera. What Fidelity is describing politely, a disconnect between positive short-term risk assets and broader structural instability, is what the rest of us would call a market that has completely detached from economic reality and is being held up by momentum, AI hype, and the gravitational pull of passive investing flows into the same 7 stocks. JP Morgan describes it as a clear split between AI-driven winners and the rest of the equity market. In the economy, strong capital expenditure contrasts with weaker labor demand and consumer spending. And the divide between high-income and low-income households is widening, creating a classic K-shaped recovery. CBS News K-shaped. That word matters. A K-shaped economy is one where the top of the income distribution is doing fine. Their stock portfolios are at all-time highs, their Apple shares are up, their AI bets are paying off, while the bottom half is getting squeezed by $4 gas, rising grocery bills, stagnant wages, and a job market that is quietly contracting in the sectors where they work. 2 different economic realities. One letter that explains why the market can hit all-time highs while consumer sentiment hits all-time lows simultaneously. And then there is the Berkshire Hathaway story that is easy to miss, but financially significant. For the first time, the 95-year-old Warren Buffett will not be the central figure on stage at the Berkshire annual meeting, marking a new era as Greg Abel took over as CEO at the start of 2026. The shift puts a spotlight on Abel and raises a question hanging over Omaha. What does Berkshire look like without the man who defined it? CNN. Why does this matter to someone who doesn't own Berkshire stock? Because Berkshire is sitting on approximately $340 billion in cash. That is the largest cash pile any company has ever held. And Buffett built that pile because he looked at the current market, overvalued tech stocks, geopolitical chaos, a frozen Fed, re-accelerating inflation, and decided that sitting in cash was smarter than buying almost anything available at current prices. Now a new CEO is running the largest cash reserve in corporate history. What Greg Abel does with $340 billion in this environment is going to tell us something very important about where sophisticated long-term value investors think the market is headed from here. So here is the full picture as of this week, May 3rd, 2026. Markets are at all-time highs because Apple crushed earnings, AI spending is surging, and passive investing keeps pouring money into the same concentrated handful of megacaps regardless of what the underlying economy is doing. The Iran war ceasefire is fragile, peace talks are stalled, and Trump said Friday the U.S. might be better off with no deal. The April jobs report drops Friday and could completely flip the market narrative if it comes in at 50,000 jobs, a number that would signal the labor market is deteriorating faster than anyone has officially acknowledged. The Fed is frozen between inflation and slowing growth, and the world's most legendary investor just handed the keys of $340 billion in cash to a new CEO who has never navigated a financial crisis at the helm. That is a lot of variables converging in the same week, and most people are just looking at the green numbers and calling it a bull market. Here is what this actually means for your money right now. All-time highs in a concentrated, fragile market are not the same as all-time highs in a broad, fundamentally supported bull run. The difference matters enormously when the thing holding it up, AI earnings momentum, shows even 1/4 of disappointment. The jobs number on Friday is not just a data point, it is a signal about whether the Fed gets unfrozen or stays trapped. And a trapped Fed in a stagflation environment is the scenario that breaks things quietly before it breaks them loudly. So watch Friday's number, watch the Iran headlines, watch what Greg Abel does with $340 billion, because right now, the market is telling one story and the economy is telling another. And eventually, one of them is going to be proven wrong. Do you think the all-time highs are justified and the AI earnings story is strong enough to carry the market through a war, a jobs slowdown, and a frozen Fed? Or do you think the disconnect between Wall Street and Main Street is finally approaching the moment where reality catches up? Drop it in the comments. Because this week proved that the financial news cycle is moving faster than almost anyone can process. And the people who understand the connections are the ones who don't get caught off guard when the story changes.